AI agents open new frontiers in banking. Major banks are boldly integrating advanced artificial intelligence into their core operations, opening a new frontier in finance and banking, much like explorers venturing into an unknown galaxy. Wall Street giant Morgan Stanley is at the forefront of this transformation, becoming one of the first major institutions to open its vast wealth management platform to autonomous AI agents as digital co-pilots in complex financial tasks. By linking AI systems directly to its stock plan administration tools for thousands of corporate clients, Morgan Stanley aims to automate routine but critical activities such as managing employee stock plans without needing to hire more personnel. This revolutionary approach, one of the earliest instances of a bank allowing external AI agents access to its systems, has the potential to vastly improve efficiency, mirroring how human-guided robots undertake tasks in space exploration to extend the reach of human capability. The move signals a paradigm shift in financial operations. AI in 2026 is progressing from a behind-the-scenes helper to a semi-autonomous digital coworker, acting under human oversight. Regulators and industry observers are watching closely as banks push these boundaries, recognizing that the actions of institutions like Morgan Stanley could set a precedent for how the industry evolves with AI at the helm. Morgan Stanley's initiative underscores an emerging consensus that embracing AI is critical for maintaining a competitive edge in financial services. The bank has already attributed roughly $1.2 trillion in client assets to its digitally driven workplace financial services strategy, and leaders believe allowing companies' own AI agents to directly access its platforms will only deepen that engagement. This bold step discards a once sacrosanct notion that clients must stick to the bank's proprietary software interfaces. Instead, Morgan Stanley is adopting an open standard that lets AI tools plug directly into its data systems, enabling corporate customers and their employees to interact via intelligent digital agents within their regular workflows. In effect, the bank has flung open its digital doors, analogous to a starship inviting allied autonomous robots aboard to help manage a complex mission, trusting that robust security protocols like the Model Context Protocol will keep operations safe. While rivals like JP Morgan and Goldman Sachs are also heavily investing in AI, they have thus far confined these systems to internal use for tasks like coding and risk management. Morgan Stanley's public embrace of external AI connectivity is a milestone indicating a high level of confidence in this technology's maturity. If it succeeds, it's likely that other banks will follow suit, unleashing a wave of industry-wide innovation and forcing every player to adapt or risk falling behind. The promise of agentic AI in banking is immense, though it comes paired with new responsibilities. Experts foresee routine financial operations rapidly being handled by algorithms that can execute trades, manage compliance checks, and respond to client inquiries at lightning speed, freeing human professionals to focus on creative problem-solving and client relationships. Like pioneers striking out for new planets, forward-thinking banks are moving into uncharted territory, balancing optimism about productivity gains with caution regarding oversight and ethics. Industry stakeholders stress that a human-centered approach remains key. Even as AI takes on more tasks, it is meant to augment human decision-making, not replace it, ensuring that empathy and trust remain central to finance. Many in the industry view this crossover of human and machine capabilities as a beacon of hope for a more efficient, inclusive, and innovative financial system, where technology helps to democratize financial services, improve accuracy, and expand access to the final frontier of global prosperity. The journey into this new era is just beginning, but with each milestone, like Morgan Stanley's brave step, finance edges closer to a future both technologically advanced and fundamentally human in its focus on service and shared progress. Subtopic: Morgan Stanley's AI-powered wealth management pivot. Morgan Stanley's groundbreaking strategy to integrate external AI agents into its wealth management and stock plan administration services highlights the need for banks to adapt or risk being left behind. The firm's wealth division, which manages over $7 trillion in client assets, is deploying autonomous digital agents to assist big corporate clients with complex stock plans and benefits, reflecting a view that future interactions with finance will be mediated by intelligent systems seamlessly integrated into everyday business operations. By embracing a model where AI handles essential but labor-intensive processes designed to convert employees managing equity into long-term wealth management clients, Morgan Stanley signals confidence that these digital helpers can maintain accuracy and security at scale. The bank is essentially inviting client-developed AI assistants into its system through secure protocols, in contrast with the banks of old that guarded their platforms like a closed city, illustrating how much attitudes have changed. This approach is about scaling services beyond human limits. Just as adding more astronauts can expand a space station's capacity, these bank-approved AI coworkers aim to expand financial service capacity without needing exponential headcount growth. The company's early experiments with a few partner firms have shown promising results: faster data retrieval, 24/7 operational support, and more personalized client experiences. Should these trials continue to succeed, we can expect other major financial institutions to roll out similar AI-powered initiatives, ultimately benefiting customers worldwide with more proactive service and fueling a virtuous cycle of innovation across the banking industry. Markets navigate tech rallies' twists and turns. A wave of volatility washed over global markets as investors digested surprising economic news, highlighting how quickly risk sentiment can shift in today's high-speed trading environment. In the wake of an unexpectedly strong U.S. jobs report, stocks experienced a sharp but contained sell-off, breaking a remarkable 9-week winning streak for the S&P 500 and sending the tech-heavy Nasdaq down nearly 4%, its worst single-day decline since the market tumult of early 2025. The trigger was a combination of robust employment data and a bit of disappointment in the semiconductor sector, which together spurred fears that central banks may keep interest rates higher for longer to counter inflation. Surging government bond yields and a slide in major chip stocks like Broadcom and Nvidia accelerated the downturn, with investors recalibrating their expectations after an exuberant rally that had lifted many technology shares to astronomical heights. Yet, despite the jolt of turbulence, many analysts noted that the retreat was orderly and perhaps even overdue after weeks of relentless gains, characterizing it as a healthy pause on an otherwise upward trajectory for markets. With the broader economy proving resilient, indeed, strong hiring is a sign of underlying growth. Market participants see this as a temporary rebalancing rather than a harbinger of a deeper crash. The backdrop to this episode of Volatility was a period of extraordinary optimism fueled by breakthroughs in artificial intelligence and futuristic technologies, which had propelled tech stocks to new orbits in the months leading up to this pullback. Traders and long-term investors alike had been riding a powerful wave of enthusiasm for anything AI-related, from cloud computing giants to innovative chip makers building the hardware for machine learning. A movement some liken to a modern-day space race in the markets, with companies competing to reach the next frontier of innovation first. However, as stock valuations soared, whisperings of a bubble began echoing through Wall Street corridors, reminding veterans of past booms that turned to busts. The sudden sell-off, sparked by a modest stumble in chip earnings and a hawkish tilt in interest rate expectations, served as a reality check, tempering the most speculative excesses. Still, experienced voices like BlackRock's chief investor Rick Rieder argue that opportunities in the technology-led bull market continue to outweigh these risks, urging investors to stay in the game as the technology-driven growth trend remains intact. Many industry leaders believe that the fundamental drivers of the rally, including corporate investment in next-generation tech and consumer demand for innovation, have far from run their course. Looking ahead, the atmosphere in financial markets remains cautiously optimistic even as it becomes more selective. The consensus among strategists is that we have entered a phase where investors will differentiate more between companies, rewarding those showing real earnings growth and durable innovation while cooling toward those fueled purely by speculative hype. This more discerning attitude may ultimately lay the groundwork for a more sustainable climb, much like a spacecraft calibrating its trajectory mid-flight to ensure a stable orbit instead of burning out. As much as some fear that the exuberance surrounding technological advances could flame out, many stakeholders see this transitional moment as a chance to reinforce solid fundamentals. With productivity advancements from AI and other innovations potentially boosting corporate earnings in the long run, the mood is one of careful watchfulness rather than panic. Ultimately, the recent market shakiness is framed as part of a natural cycle of consolidation and reflection in a longer journey toward a tech-forward economic horizon, guided by the twin stars of innovation and resilience. Subtopic: Chip sector's high-flying ride suffers a swift correction. One of the most dramatic microdramas behind the broader market's twists was the rapid reversal in semiconductor stocks, which had been on a stratospheric rise thanks to insatiable demand for AI chips and optimistic revenue forecasts. Semiconductor bellwethers like Broadcom, key suppliers for next-generation networking and AI hardware, saw their shares tumble by high single-digit percentages after issuing financial outlooks that, while strong in absolute terms, fell just short of the market's sky-high expectations. This disappointment swiftly cascaded through the chip industry, wiping out over $1 trillion in market value across leading tech companies in a single trading day and underscoring the sensitivity of valuations to even subtle shifts in narrative. Analysts note that these chip firms had enjoyed an unprecedented run-up, some nearly doubling in value within a matter of months, as investors anticipated an AI gold rush and snapped up anything associated with advanced computing power. The correction has brought these rocket-like trajectories slightly closer to Earth, but it also revealed the enduring strength of the sector. Even after the pullback, most chip companies remain significantly higher than they were at the start of the year, reflecting the genuine long-term confidence in their role powering a new era of technology. Many industry watchers expect a rebound once short-term jitters pass, as companies with robust revenues and technological prowess in semiconductors are still poised to benefit from the continuous expansion of digital infrastructure, artificial intelligence, and even extraterrestrial communications in the years ahead. For the time being, semiconductors continue to be viewed as essential building blocks of the future digital economy. Central banks chart a new course amid economic resurgence. Global central banks are facing a pivotal moment as a rebounding economy forces them to recalibrate their strategies in real time. A blockbuster U.S. employment report for May, showing roughly 172,000 new jobs added, roughly double what analysts expected, has underscored the surprising resilience of the world's biggest economy, putting to rest any lingering fears of an imminent downturn. Unemployment remains near historically low levels, a testament to sustained labor market strength that some liken to a powerful rocket booster propelling economic growth higher than earlier forecasts. But this welcome sign of vitality comes with a twist. Stronger growth is prompting policymakers to reconsider interest rate cuts many had anticipated, raising the prospect that benchmark rates may stay elevated longer to tame persistent inflationary pressures. For newly installed Federal Reserve Chair Kevin Warsh, preparing for his first policy meeting later this month, these developments mean the path ahead is more complicated than initially thought. He had been widely expected to lean toward monetary easing, but now faces a chorus of colleagues suggesting that further rate hikes might eventually be necessary if inflation doesn't recede. Around the world, other central bankers, too, are making similarly fine-tuned adjustments, from the European Central Bank grappling with stubborn price increases amid slower growth, to emerging market policymakers balancing capital flows and currency stability. The upshot is a delicate balancing act. Leaders of the financial system are navigating by starlight, steering between fueling growth and quelling inflation on a journey that has no easy map. The financial markets are carefully parsing each word from central bankers to divine the future of monetary policy. The strong labor market data gave a jolt to bond and stock markets, as traders quickly priced in a higher chance that the Federal Reserve will maintain or even raise interest rates rather than cut them this year. This pivot in expectations contributed to a swift rise in government bond yields and a short-term pullback in equities, particularly high-valuation sectors like technology, which are sensitive to higher borrowing costs. Despite the initial shock to markets, many economists and investors remain heartened by the underlying reason: robust economic fundamentals in jobs and output, which suggest that any policy tightening is a response to success, not failure. As inflation shows signs of gradually easing from the peaks of previous years, the narrative is shifting from one of crisis fighting to one of cautious course correction, a necessary step for ensuring long-term economic stability. In one sense, central bankers are akin to astronauts plotting a space trajectory. They fired powerful engines to escape the gravity of recession and must now carefully adjust the throttle to set the economy into a sustainable orbit. Warsh and his peers have signaled they are ready to act carefully and data-dependently going forward, indicating a commitment to keep an open mind and adapt swiftly as new information arrives. As policymakers attempt to guide their economies to a soft landing, the tone remains cautiously positive. International monetary institutions and market participants are emphasizing cooperation and prudent planning, drawing lessons from past cycles where over-tightening or too much looseness led to turbulence. The consensus is emerging that while the era of emergency stimulus is decisively over, central banks will remain supportive of growth as long as price stability is not in jeopardy. If they calibrate policy correctly, the payoff could be a period of steady expansion and moderate inflation, providing fertile ground for businesses, workers, and investors alike. The kind of stable macroeconomic backdrop that allows innovation and human potential to flourish. The journey isn't without risks, and officials often remind the public that external shocks or policy missteps could still knock things off course. Yet the prevailing sentiment is one of cautious optimism. Like a skilled mission crew adjusting a spacecraft's path, global central banks are striving to ensure that the remarkable momentum of today's economy can transition into a sustainable, inclusive prosperity for tomorrow. Subtopic: New Fed chair faces a trial by fire. The first major test for newly appointed Federal Reserve Chairman Kevin Warsh has arrived swiftly. As glowing economic numbers challenge initial expectations that he would quickly pivot the U.S. central bank toward easier policy. An advocate for leveraging productivity gains from technology to tame inflation, Warsh's pre-appointment view was that the spread of artificial intelligence and other innovations might naturally ease price pressures by boosting efficiency. However, the latest data places him on a tightrope. The labor market strength is evidence of a robust economy, yet stubborn inflation indicates that policy cannot be loosened prematurely without risking renewed price spirals. Warsh's colleagues at the Fed, including some initially skeptical of further tightening, are increasingly persuaded that additional modest rate hikes might be in order if price growth stays above target. The outcome of this first meeting under his gavel is being watched closely by global investors and policymakers, seen as a bellwether for how the world's most influential central bank will steer in a post-pandemic, tech-accelerated era of growth. For Warsh, the challenge will be to harmonize the Fed's response with market expectations and political pressures while guarding the hard-fought credibility of the institution. How he manages this delicate scenario could define not only his tenure, but also set the tone for the intersection of high-tech economic potential and the traditional tools of monetary governance in this new chapter of the global financial journey. Crypto market volatility spurs focus on real-world applications. The once red-hot cryptocurrency market has entered a period of sobering realignment, as speculative fervor makes way for a more nuanced focus on practical uses of digital assets. In recent days, Bitcoin, the bellwether of the crypto world, slid under a closely watched price threshold, touching its lowest level in over a year and losing much of the momentum it built up during the last bull run. Observers attribute the decline to a combination of profit-taking, a shift in investor attention toward mega-cap technology stocks and new initial public offerings, and a general recalibration of risk amid shifting interest rate expectations. Just as importantly, the retreat comes as the era of easy money that once fueled crypto speculation has given way to a more discerning environment, Higher global interest rates mean investors are less willing to chase volatile moonshot assets without clear value propositions. Some crypto enthusiasts see the current slump as a necessary cooling period akin to a spaceship adjusting its trajectory after an overheated launch, allowing the industry to burn off excess speculation and refocus on sustainable progress. While the wild price swings have certainly tested the resolve of casual investors, industry veterans note that similar boom and bust cycles have played out before and can ultimately strengthen the ecosystem by weeding out weaker projects. Amid this turbulence, there are growing signs that the future of digital assets lies beyond the trading frenzy and in more grounded, real-world applications. Cryptocurrencies and their underlying blockchain technology are gradually being woven into the fabric of mainstream finance, from back-office settlements to cross-border payments, though often behind the scenes without the hype. Over the past year, financial institutions and corporations have increasingly explored ways to harness digital tokens for efficiency, for instance, by tokenizing tangible assets such as real estate, commodities, or bonds to make them more easily tradable. This segment of the crypto universe, often referred to as real-world asset tokenization, has quietly gained traction, reaching an estimated market size in the tens of billions of dollars after growing exponentially from a near-standing start just a few years ago. Likewise, so-called stablecoins, digital currencies pegged to traditional fiat currencies, have risen in prominence as a potential bridge between old and new financial systems, offering the advantages of crypto, like fast, borderless transactions, with far less volatility. In the United States, for example, legislative changes have been paving the way for greater stablecoin oversight, contributing to increased institutional interest. While major global banks are now testing blockchain-based platforms to settle trades more quickly and cost-effectively. These pragmatic developments represent a shift from viewing crypto purely as speculative digital gold towards seeing it as a technology that can streamline and democratize financial services. Looking ahead, many analysts expect that the maturation of the crypto sector will continue, characterized by closer engagement with regulators and the integration of digital assets into traditional financial infrastructure. The exuberant Wild West days of unregulated coin launches and overnight riches may be fading, but they are being replaced by a more solid foundation built on regulatory clarity and real economic utility. Governments and central banks from Europe to Asia are deliberating policies for digital currencies and blockchain, signaling a broad acceptance that these innovations will play a role in the global economy's next chapter, provided they can be managed safely. In this more mature phase, collaboration between crypto innovators and established financial institutions is set to deepen, from central bank digital currency pilots to partnerships where banks offer crypto custody or blockchain-enabled services. Some visionaries even predict that as blockchain networks become more efficient and sustainable, they could form part of the backbone of a future financial system that extends beyond Earth, facilitating secure interplanetary commerce in a distant era of space travel. While that may sound far-fetched, the underlying message is that digital assets are moving from the margins to the mainstream, evolving from a speculative asset class into an integral, if still nascent, component of the modern financial tapestry. Subtopic: Stablecoins provide a lifeline in volatile economies. A clear example of cryptocurrencies finding tangible purpose can be seen in the growing reliance on stablecoins in several emerging markets facing currency instability. In countries like Nigeria and South Africa, where local currencies have suffered devaluation and foreign exchange shortages, businesses and individuals are increasingly turning to dollar-pegged stablecoins, digital tokens that maintain a steady value by being tied to the US dollar, as a reliable store of value and medium of exchange. These digital dollars are used for cross-border trade, allowing importers to pay suppliers in a currency that holds its worth better than their own, and enabling families to receive remittances without the fear of sudden exchange rate losses. Recent industry surveys and reports indicate a remarkable surge in stablecoin transactions across Africa's largest economies as participants seek alternatives to navigate economic volatility. Some local fintech startups have begun providing user-friendly mobile apps that let anyone swap local cash for stablecoins and vice versa, effectively bringing sophisticated financial tools to populations underserved by traditional banks. International regulators and development experts are watching these trends with interest, noting that if properly overseen, the proliferation of stablecoins could help foster greater financial inclusion and stability in vulnerable economies. A small but significant step towards leveling the global playing field in the era of digital finance. Investors embrace mammoth tech IPOs as liquidity abounds. A frenzy of capital raising is sweeping through the financial world as some of the planet's most valuable private tech companies gear up to sell shares to the public. In an atmosphere supercharged by advances in artificial intelligence, giants like OpenAI and Anthropic, along with space and technology powerhouse SpaceX, are reportedly preparing for enormous initial public offerings, IPOs, that could see them valued in the trillions of dollars collectively. It has been years since markets witnessed such a concentration of high-profile stock debuts, and the sheer size of the deals on the horizon is straining the imagination of even seasoned Wall Street veterans. Goldman Sachs CEO David Solomon remarked that we are definitely in a moment where there's more greed than fear, pointing to surging investor appetite for these AI-focused companies and noting that plenty of liquidity is available to fund a historic wave of equity issuance. The optimism isn't abstract. Technology juggernauts are raising sums that once seemed impossible. Alphabet's recent announcement of an $80 billion follow-on stock offering barely put a dent in its share price, suggesting investors remain ravenous for exposure to the future growth these companies promise. Many market participants view these developments as validation that technological innovation is now the main engine of wealth creation, fueling a virtuous cycle where massive capital inflows allow disruptive companies to scale faster and tackle audacious projects, from transforming industries on Earth to exploring new frontiers beyond it. Still, as public markets prepare to absorb these titanic offerings, voices of caution remind us that booms can become overheated. The planned valuations for some upcoming IPOs evoke comparisons to the dot-com era or the great bull runs of the past, raising questions about sustainability. Even Solomon, while bullish on the ample liquidity, acknowledges that greed can turn into fear very quickly if exuberance isn't eventually justified by results. Prudent investors are combing through the fundamentals, revenue models in artificial intelligence, ownership structures, and the long-term business plans of these companies, aware that even the most dazzling technology has to translate into sustainable profits to support sky-high valuations. Yet a counter-narrative is taking hold among many analysts and forward-looking investors that we may be on the cusp of a golden age of innovation-driven growth, meaning this is just the beginning of a long-term economic upcycle. Some even argue that we are earlier in the cycle than later, implying that the current enthusiasm, far from being a last gasp of a bubble, could be the start of a profound transformation in how capital markets finance human progress. For now, the mood inside large investment banks and stock exchanges is a mix of excitement and vigilance. They are assembling enormous underwriting teams and conducting global investor roadshows via virtual meeting rooms, drumming up demand across continents. The likely entry of these tech titans into public markets in the coming months is being framed as a litmus test for the depth of global capital pools and as an indicator of confidence in technology's promise to reshape economies. Early responses have been encouraging, with institutional investors signaling strong interest and even individual investors eager to participate in what they see as once-in-a-generation opportunities. Observers note that the willingness of markets to shoulder such huge offerings suggests a belief that transformative technologies like AI, space infrastructure, and quantum computing can unlock new value streams for decades to come, similar to the once ambitious endeavors of the early space race that ended up revolutionizing global society. The collective hope is that careful management and sober judgment will prevail even amid the buzz, so that this era's bold ventures lift off smoothly and contribute positively to economic growth rather than flaming out. Subtopic: Alphabet's massive stock sale signals appetite for tech. In an illustrative precursor to the coming IPO wave, Google's parent company Alphabet recently floated an enormous $80 billion secondary stock offering, an unprecedented size for an established tech titan, and was met with a swell of investor demand. Remarkably, instead of causing its share price to swoon under the weight of so much potential new supply, the stock held strong and even edged higher, which executives and analysts interpret as evidence of investors' deep faith in the future of technology-led growth. Alphabet's successful capital raise has effectively demonstrated that markets are not shying away from funding innovation at scale. On the contrary, the company's smooth sail has been encouraging news for firms like OpenAI and SpaceX, which are exploring even larger fundraisers. Market strategists have pointed out that this result underscores a robust appetite across the investor spectrum, from Wall Street institutions to everyday individuals using trading apps, to put money into ventures tied to artificial intelligence, cloud computing, and the expanding digital economy. The fact that Alphabet can raise a sum that would dwarf most countries' annual budgets without roiling markets suggests the presence of a vast reservoir of liquidity seeking high-growth opportunities. It also hints that as long as the growth narrative remains persuasive, shareholders are willing to support tech giants in their quest to build the future, providing a crucial tailwind to innovation and long-term value creation in ways that could ripple throughout the global economy. Fintech firms face a reckoning in the wake of an AI boom. The rise of generative artificial intelligence is sending shockwaves through the startup and fintech ecosystem, forcing a generation of companies to either evolve or face an existential reckoning. Recent data show that nearly half of the roughly 857 privately held unicorn startups in the United States, firms valued at $1 billion or more, have not been able to raise new funding in the past 3 years, leaving many of their sky-high valuations frozen or falling. In fact, startups that last raised funds during the peak of the easy money era in 2021 have seen their valuations drop by an average of 2/3, and even those that last raised in 2022 are down by more than half on paper, as investor sentiment has pivoted dramatically. The main catalyst for this abrupt shift is the AI revolution ignited by breakthroughs such as OpenAI's ChatGPT, which arrived in late 2022 and transformed expectations overnight. Venture capital and public markets alike have funneled hundreds of billions of dollars toward AI-focused enterprises, leaving non-AI businesses struggling to attract new capital. More than 200 once buoyant startups have already slipped from their billion-dollar status to become fallen unicorns. A roster that includes consumer darlings and fintech pioneers that just a few short years ago were expanding rapidly but have since hit a funding wall. This phenomenon illustrates a harsh reality of technological progress. When a transformative innovation emerges, it can make preceding business models look outdated virtually overnight, akin to how satellites rendered older communications infrastructure obsolete. Seed-stage investors and venture capitalists say that the environment has bifurcated. On one side, exciting new AI-native startups are raising money at breathtaking valuations. On the other, older firms that blossomed under past tech trends find themselves needing to pivot quickly to remain relevant. One venture capitalist compared the moment to a forest where towering trees have suddenly been overshadowed by a fast-growing new species, the new species being generative AI ventures, forcing other flora to either adapt to the changing light or wither. Fintech startups and even more established digital finance players are acutely aware of this pressure. Many are racing to integrate AI into their services, from customer service chatbots to algorithmic decision-making engines, in hopes of rejuvenating their growth story and convincing investors that they too are plugged into the future. Companies that once captured imaginations with innovative online banking platforms or payment solutions now see the need to incorporate sophisticated machine learning to maintain an edge. Though it's a challenging period for those caught off guard by the pace of innovation, industry leaders emphasize that this kind of shakeup can ultimately benefit the broader ecosystem, making way for more efficient business models and leaner, more resilient enterprises. Amid the turbulence, some forward-looking firms have managed to steer their ships into calmer waters by embracing the very forces disrupting their peers. A number of fintech and software companies are reinventing themselves by acquiring AI startups or launching internal innovation labs dedicated to machine learning and automation. Their aim is to harness the power of AI to reduce costs, improve customer experience, and unlock new revenue streams, reaffirming to investors that they can compete in this new paradigm. Industry examples abound. Robo-advisory pioneers in digital wealth management are layering generative AI into their platforms to offer hyper-personalized investment guidance, while veteran e-commerce and software-as-a-service providers are retooling their services with AI-driven analytics to deliver better value to clients. These adaptations show that not all is doom and gloom for pre-AI players. Rather, some are proving remarkably resourceful and creative, forging partnerships and refocusing their strategies in ways that evoke the adaptability of early space programs meeting unforeseen challenges in their missions. While many older startups will indeed struggle or disappear, the prevailing hope in the tech community is that those who successfully transform will help drive the next chapter of growth, combining experience with innovation to push the boundaries of what financial technology can do for people and businesses around the world. Subtopic: Reinvention of a fintech trailblazer in the AI age. One prominent fintech firm that emerged as a pioneer in online financial planning and investment services during the late 2010s recently made headlines for a bold pivot to embrace the AI wave. After years of steady growth followed by a lull in venture funding, the company's leadership publicly unveiled a new roadmap that places artificial intelligence at the core of its next evolution, including rolling out personalized financial advice generated by advanced machine learning algorithms. This shift came alongside a partnership with a noted AI research lab, providing access to cutting-edge natural language processing capabilities that will help the platform turn vast troves of user data into tailored, human-like recommendations for individuals managing their savings and portfolios. Industry watchers applauded the move as an example of how a once disruptive startup can adapt to a fresh wave of disruption by acknowledging that yesterday's innovations must be upgraded with the tools of today. Investors responded positively too, with the firm's latest funding round, modest by the standards of previous booms, nonetheless oversubscribed due to renewed excitement about its potential to harness AI effectively. The narrative around this company has shifted from one of stagnation to one of renaissance, rekindling optimism that older fintech players can still innovate and compete. In a broader sense, such stories offer hope that even as transformative technologies rapidly change the game, creative adaptation and a focus on serving human needs with advanced tech can allow seasoned companies to reclaim a place in the industry's future trajectory. Private credit soars as firms seek alternatives to bank loans. As banks tighten lending under stricter capital rules, a quiet revolution is stirring in the world of corporate finance. Private credit is surging to fill the void. Once a niche corner of the market, private credit has expanded its reach dramatically, creating new avenues for companies to secure financing outside traditional bank loans or public bond markets. Industry research indicates that private credit, which includes lending by non-bank institutions like private equity firms, asset managers, and specialized funds, is now influencing an enormous global lending market worth roughly $40 trillion or more. In fact, some estimates suggest that private credit providers could shoulder as much as 15% of worldwide corporate lending in the near future as businesses searching for capital pivot toward these more agile funding sources. This shift is partly driven by higher interest rates and regulatory constraints that are making banks more cautious about extending credit, especially to riskier ventures, leaving companies hungry for alternative funding for growth, acquisitions, or restructuring. Private debt funds, flush with investor capital, have stepped in to offer bespoke loans that can be arranged faster and with more flexibility than traditional bank financing, albeit often at higher interest costs. This trend represents a significant transformation in how credit is supplied, one that financial insiders liken to the emergence of a new supply route in the economic ecosystem, similar to opening a fresh channel in a vast and previously bank-dominated ocean of capital. The growth of private credit is evidenced not only by direct loans, but by the booming secondary market for these assets, which hit record levels over the past year. Data from financial advisory firms show that trading volume for slices of private credit deals, known as secondary transactions, reached well over $200 billion recently, reflecting how investors value the liquidity and yield such instruments provide. In the absence of a vibrant market for initial public offerings during volatile times, companies that need financing have increasingly turned to these private channels for large-scale capital, leaning on so-called shadow banks to fund everything from real estate developments to corporate buyouts. This disintermediated lending model has injected resilience into credit markets by giving borrowers more options when banks are constrained, and by allowing investors, such as pension funds and sovereign wealth funds, to earn higher returns through private loans. Some finance leaders see this as akin to constructing a parallel pipeline of credit to the economy, one that can keep flowing even if traditional banks pull back. They note that such diversity of funding sources can make the overall financial system more robust by distributing risk and preventing credit crunches, as long as the new market grows responsibly and transparently. The rapid expansion of private credit has not gone unnoticed by regulators and market watchdogs, who are working to assess its implications for financial stability. The concern centers on the opaque nature of this market, because private credit deals often happen outside the purview of public markets and traditional bank oversight. There is a risk that hidden pockets of excessive leverage or poorly underwritten loans could build up. Global regulatory bodies, such as the Basel Committee on Banking Supervision, have pointed to one particular practice, known as significant risk transfer, in which banks offload loan risk to private funds, as an area requiring careful monitoring. While such transactions can help banks reduce their exposure and free up capital, too much reliance on transferring risks to unregulated entities might leave the financial system vulnerable if those entities falter under stress. Nonetheless, proponents argue that prudent oversight can mitigate these concerns and that private credit is here to stay, having become a key feature of modern finance, like a new star in the credit universe that must be understood and guided rather than resisted. With continued innovation in how deals are structured and greater transparency, private credit could complement traditional banking, providing fuel for businesses and growth even when conventional faucets run dry. Subtopic: Scrutiny of risk-sharing deals grows as private lending booms. Financial regulators worldwide have started to focus on the intersection between traditional banks and the burgeoning private credit sector, particularly honing in on transactions where banks transfer loan risk to non-bank entities. These arrangements, often dubbed significant risk transfers, enable banks to effectively sell off portions of their loan portfolios to private funds or insurers, thereby reducing the bank's capital requirements and risk exposure while providing extra yield to investors. The worry among oversight agencies is that if too much of the banking system's credit risk migrates into the shadows, any cracks in those private markets could have boomerang effects back onto banks and the broader economy. The Basel Committee, which sets global banking standards, has cautioned that these deals, if left unchecked, might weaken the financial system's resilience by concentrating risk in less regulated corners of the credit world. In response, there are calls for enhanced transparency and possibly new guidelines to ensure that banks maintain enough skin in the game when engaging in such transfers. Despite these concerns, regulators also acknowledge the benefits. By carefully supervising these innovations, they hope to strike a balance that allows private credit to continue providing alternative funding to the economy while safeguarding against hidden vulnerabilities. This collaborative approach reflects a maturing view that the evolving credit landscape can be harnessed to strengthen financial stability, much like an advanced navigation system that helps a spacecraft stay on course, provided all actors maintain prudent risk management and open communication with regulators as the journey unfolds. Technology transforms finance jobs, sparking upskilling and new opportunities. In a striking turn of events, the advance of artificial intelligence in finance is not resulting in mass human obsolescence, as once feared, but is instead giving rise to new roles and a surge in upskilling efforts across the industry. Rather than widespread job losses, Experts now predict that AI's influence will reshape jobs, augmenting human capabilities and shifting workers into higher-value tasks that leverage creativity, judgment, and interpersonal skills that machines cannot replicate. In fact, the narrative in boardrooms and at economic forums in 2026 has pivoted to emphasize the urgent need for skilled talent to implement and oversee advanced technologies. The World Economic Forum recently identified the talent gap in fields like AI engineering, data science, and cybersecurity as one of the most pressing challenges for financial institutions. Banks and investment firms around the globe are finding that competition for employees with these cutting-edge skills is fierce, leading to rising compensation packages for top performers and a renewed focus on cultivating talent from within. The shortage of technology-trained professionals has been likened to a new space race, not of rockets, but of human capital, with companies racing to attract and develop the brightest minds to guide them through a digital transformation. In parallel, the nature of financial services work is evolving. Routine tasks are increasingly automated, freeing staff to focus on strategic planning, complex client relationships, and innovative product development, which many leaders see as a net positive for both employee satisfaction and long-term productivity. To meet the demand for new skills, the finance industry is undergoing an education revolution from the inside out. Major banks are investing heavily in training programs, partnering with universities and technology firms, and building internal academies to ensure their workforce remains relevant and empowered. For example, Lloyds Banking Group in the United Kingdom launched an AI Academy, aiming to make all 67,000 of its employees conversant in artificial intelligence tools and ethical best practices by the end of 2026. A sweeping initiative that underscores how seriously the bank views digital literacy. Across the Atlantic, venerable institutions like Bank of New York Mellon, America's oldest bank, are reportedly pouring billions into technology upgrades and employee AI bootcamps to turn everyday staff into citizen developers and analysts equipped to harness AI in their daily roles. Even globally, firms like JP Chase have rolled out programs to train hundreds of thousands of employees in data analytics and machine learning basics, reinforcing the idea that every worker should have some level of competency with these transformative technologies. The collective push for upskilling reflects a recognition that human expertise remains the beating heart of finance. Algorithms may crunch numbers at lightning speeds, but it takes skilled people to design, interpret, and ethically implement those algorithms in ways that truly benefit customers and society. There is a growing optimism that, with the right training and adaptation, the financial sector's workforce can thrive alongside intelligent machines. Early evidence suggests that companies which invest in their people's digital skills see not only improved efficiency, but also rising employee morale, as staff feel better equipped for the future and more engaged in driving their company's innovation. Industry leaders often frame the journey as one of coevolution, humans and AI working together as complementary partners, much like an astronaut relying on advanced instruments to navigate uncharted space, while still making critical human judgments during the mission. By fostering a culture of continuous learning and flexibility, financial firms are building resilience into their teams, ensuring that they can adjust to rapid changes and seize emerging opportunities. The overall message is one of empowerment and hope. The industry foresees a future where technology amplifies human potential rather than replacing it, leading to better services for customers and a reinvigorated sense of purpose for the professionals who steward the world's capital flows. Subtopic: Pioneering upskilling initiatives show early benefits. Some of the financial industry's boldest upskilling programs are already yielding encouraging results, providing blueprints for others to follow. The ambitious AI Academy at Lloyds Banking Group, for instance, has so far enrolled tens of thousands of employees in interactive courses and hands-on workshops focused on practical AI skills and ethical considerations. Within months of launch, many participants have begun applying their new knowledge to streamline processes and detect patterns in data that might have been missed before, demonstrating immediate improvements in efficiency. At Bank of New York Mellon, a series of internal, digital bootcamp sessions and hackathons has led to a burst of employee-led innovations, from automating back-office tasks with simple AI scripts to devising improved customer service tools, illustrating how empowering staff with modern skills can drive bottom-up innovation. Such initiatives also appear to pay cultural dividends. Companies report that employees feel more confident and engaged, seeing themselves not as cogs threatened by automation, but as active agents shaping the future. As more success stories emerge from these programs, it becomes clear that investing in people is just as crucial as investing in hardware or algorithms when aiming to build a truly future-ready, human-centric financial institution. Emerging markets drive growth and innovation on the global stage. While some advanced economies grapple with slowing growth and aging demographics, many emerging markets continue to shine as vibrant engines of expansion and innovation. Across parts of Asia, Africa, and Latin America, rising middle classes and ambitious technological adoption are helping sustain brisk economic growth rates that outpace those in Europe or North America. India, for instance, stands out as one of the world's fastest-growing major economies, with annual growth hovering in the mid-single digits despite global headwinds, a performance that has attracted increased interest from international investors looking for higher returns. Meanwhile, countries across Southeast Asia and Africa are capitalizing on digital technology to leapfrog traditional developmental hurdles, from mobile payments that bring banking to previously unbanked populations, to e-commerce booms driving entrepreneurship and consumer spending. Even as these nations navigate challenges like inflation and external debt, many have shown remarkable resilience, adapting through economic reforms and prudent fiscal management that signal increasing stability to the world. This dynamic momentum in emerging markets is a reminder that the next chapter of the global economy may well be written not only in the traditional financial centers, but in the rapidly evolving cities and tech hubs across the developing world. A phenomenon often likened to the discovery of new, resource-rich planets that promise to reshape the cosmic balance of economic power. The innovation unfolding in emerging economies is not limited to consumer technology. It is also transforming the financial systems and markets that underpin growth. A wave of capital market developments has swept through these regions, with several countries enhancing their stock exchanges and bond markets to attract global investors and mobilize domestic savings for development projects. Some governments are forging ahead with central bank digital currencies and blockchain-based trade finance platforms, recognizing that being at the forefront of fintech could give them a leap in efficiency and transparency over more established rivals. Moreover, strategic trade alliances and regional initiatives, such as the African Continental Free Trade Area Agreement, are creating larger unified markets that can drive economies of scale and make these countries more competitive. For global investors, these improvements are not going unnoticed. Funds that specialize in emerging market assets have seen renewed inflows as portfolio managers seek to capitalize on both the growth prospects and the undervalued assets present in these economies. The agility displayed by emerging market businesses in adopting technology, sometimes out of necessity, is often accompanied by a strong growth hunger, reminiscent of a rocket launching from Earth's surface in search of new heights. Of course, investing in developing economies still carries risks, from political uncertainty to exposure to global commodity cycles. But the broad trend is one of convergence and opportunity. The gap between emerging and developed markets in key sectors is narrowing as knowledge transfer accelerates and more capital flows southward. Many analysts forecast that robust domestic demand combined with youthful, tech-savvy populations will allow select emerging nations to become leaders in fields like renewable energy finance, digital banking, and even space technology collaborations. At major economic gatherings, a palpable sense of optimism surrounds these prospects, guided by a belief that global challenges such as climate change, healthcare, and infrastructure can find new solutions emerging from these rising economies. The road ahead will require vigilance and prudent policy to avoid pitfalls, but a growing chorus of voices argues that the global financial landscape in the coming decades will be far more multipolar, inclusive, and dynamic thanks to the rise of these once peripheral markets. Subtopic: High-yield Indian bonds lure global investors. One of the most significant shifts seen in recent months is the increased appetite for Indian bonds among international investors, despite relatively high yields that traditionally signaled caution. Market analysts note that yields on Indian government and corporate bonds stand near multi-year highs, around 7% for benchmark government securities, a level that might once have scared off foreign capital due to inflation concerns. However, fund managers and economists are increasingly viewing these elevated yields as an opportunity rather than a warning sign. They argue that India's inflation appears to be moderating and its fiscal health improving, meaning today's high yields could translate into substantial gains if interest rates come down over time. A leading investment advisor at one of India's largest asset management companies has publicly highlighted the country's stable macroeconomic outlook and structural reforms as reasons for long-term confidence, even as short-term rates remain elevated. The strategy for many global funds now includes locking in Indian bond yields to diversify portfolios and benefit from both the substantial interest income and potential price appreciation. This trend demonstrates a broader recalibration in investor mindset. After years of favoring developed markets for safety, sophisticated capital is venturing again into high-potential emerging markets, buoyed by evidence that some of these economies have matured into reliable engines of growth and return. Space economy lifts off as finance reaches for the stars. The boundary between finance and outer space is blurring as the dream of a thriving space economy rapidly turns from science fiction into an investment reality. Today, industry chatter is centered on plans by Elon Musk's SpaceX to go public in what could be the largest initial public offering ever recorded. An audacious bid that may raise an eye-popping $75 billion from investors and value the reusable rocket and satellite company at well over $1 trillion. The prospect of a space firm commanding a 13-figure valuation underlines the extraordinary expectations riding on off-world commerce. From satellite broadband networks blanketing the globe to the eventual exploitation of extraterrestrial resources, global markets appear eager to back these cosmic ambitions with serious capital. Stock exchanges are preparing for the arrival of a new generation of space companies, and early indications suggest heavy demand from both institutional and retail investors who see this as a chance to buy into humanity's next giant leap. SpaceX's anticipated debut follows its lightning-fast growth as a private company, launching hundreds of rockets with unprecedented reliability and slashing the cost of access to orbit. And with the planned IPO, some analysts are calling it a recalibration of how public markets value infrastructure and exploration ventures. In a very literal sense, finance is fueling the expansion of humanity's presence beyond Earth. Beyond the headlines around SpaceX, the broader space industry is quietly continuing its ascent as a bona fide pillar of the global economy. Analysts estimate the current size of the space economy at well over $500 billion, encompassing everything from communications satellites and Earth observation data to burgeoning sectors like space tourism and even asteroid mining concepts. This figure has been climbing steadily each year as technology improves and launch costs fall. By some projections, the space sector could exceed $1 trillion in annual revenue within the next decade. In 2025, a record 260 successful orbital launches were conducted worldwide, enabling the deployment of vast satellite constellations that are revolutionizing connectivity, navigation, and climate monitoring for everyone back on Earth. Both government space programs and private firms are accelerating their activities. NASA's Artemis program aims to return humans to the moon and establish a long-term presence there, while emerging players in Europe, China, and India are building and launching their own rockets and satellites. Meanwhile, venture capital investment into space startups topped $10 billion in the last year alone, financing innovations in areas like reusable spacecraft, in-orbit manufacturing, and planetary exploration. This sustained growth is drawing in the financial industry's biggest names as banks and investors realize that space is no longer a fringe curiosity, but a frontier of potentially immense economic significance. Astute observers point out that the blossoming space economy represents not just a commercial opportunity, but also a source of inspiration and hope for the future. Each successful space mission, whether it's a rover sending back images from Mars or a new satellite improving internet access in remote regions, demonstrates the power of human ingenuity and the far-reaching benefits of ambitious investments. These endeavors have started to pay dividends on Earth. Advanced satellite networks boost global communications and disaster response, while space-derived data informs agriculture, navigation, and climate science, creating value across industries. As capital flows into space projects, there is a cascading effect of technological spin-offs that can enhance life on our home planet, fulfilling a virtuous mission of growth and innovation that lifts all boats. Financial backing for space initiatives is increasingly framed as a long-term bet on civilization's progress, a belief that expanding humanity's horizons will yield both economic returns and a brighter future for humanity. In the realm of finance-turned-futurism, investors and citizens alike are beginning to imagine a world where their portfolios and pensions are partly built on revenue from the stars. This blending of visionary aspiration and fiscal strategy marks a striking new chapter, suggesting that the ultimate growth market just might lie beyond the Earth itself. Subtopic: SpaceX's record IPO ignites investor imagination. SpaceX's impending stock market debut is being hailed not only as a financial event, but as a cultural milestone. It has captured the public's imagination like no business offering before it. The company's confidential filings reportedly outline an unprecedented plan for its IPO. SpaceX will allocate a large portion of its shares, potentially up to 30% of the massive offering, to everyday investors. This level of retail share allocation would vastly exceed the typical fraction reserved for individuals in major IPOs, giving the broader public a rare chance to directly participate in the space revolution. If executed as anticipated, SpaceX's offering would eclipse all prior records, dwarfing the current largest IPO, Saudi Aramco's $25 billion debut in 2019, and instantly place SpaceX among the world's most valuable public companies. Market watchers believe this reflects the enormous optimism surrounding space enterprises, as investors are effectively pricing in years of future growth, from satellite broadband services to potential Mars colonization efforts. Some veteran analysts caution that such exuberance demands patience and careful analysis, given the inherent risks and long timelines associated with space ventures. Nevertheless, the fervor around SpaceX's upcoming IPO and the broader enthusiasm for the space sector underscore a key theme of our times: a rekindled faith in ambitious technological progress and a willingness of capital markets to bankroll challenges that were once solely the domain of governments. Disclaimer: the information provided in this news report is for informational purposes only and does not constitute legal, financial, medical, or official advice. All content is presented as news and commentary. None of the stories or analysis should be interpreted as personal advice or recommendations. Always consult with a qualified professional for advice specific to your financial or legal situation. Bulls, bots, and billion-dollar liftoffs. Inside Finance's New Frontier. Video tags: finance, banking, stock market, Federal Reserve, investing, economy, artificial intelligence.